The US equity market has taken a couple of blows recently. I'm referring to the Chinese AI model DeepSeek and the tariffs announced by President Trump over the weekend. But nevertheless, the S&P 500 is up 2.9% year to date. Over the last week, when most of these news has happened, the S&P is only down about 0.5%. The resilience of the market is even more impressive when you consider that Nvidia, which is one of the companies that sold off on the DeepSeek news, is down 14% year to date. And to see such a large cap, widely held stock down sharply and the broader market up really speaks to the resilience of the market. Am I surprised? A little bit, but I can honestly say that I said the market was going to be resilient to bad news on one of these videos a few weeks back. The reason I said the market was going to be resilient is I expected earnings reporting to be extremely strong. And we are today at roughly the halfway point on S&P 500 companies reporting earnings from the fourth quarter of 2024. And according to FactSet, year-on-year earnings growth is going to be about 13.2%. And in fact, if the companies that are going to be reporting over the next couple of weeks similarly beat estimates as the first companies did, we could even have 14% earnings growth for the fourth quarter. That's very strong earnings growth. And you can see it's very hard for people to sell stocks when they're hearing all these companies reporting on how well they're doing. I'm also going to explain now at least part of the reason why I think the market didn't sell off too heavily on the DeepSeek news or too heavily on Trump's tariffs. We'll call this a glass as half full explanation. Of course, Nvidia shares are down and some other shares are down on the DeepSeek news because the expectation is that future AI models will be more efficient than the ones that are running right now, and maybe that past estimates for just tremendous numbers of gigantic data centers, well, will have to be scaled back a little bit. I'd like to point out to you a column that was written in Fortune.com by the CEO of IBM, Arvind Krishna, where he said that he and his colleagues at IBM had been predicting for some time that the cost of AI inference, and that means the cost of how much it costs for the AI model to think, was going to drop by 30-fold. So he published that to kind of toot his own horn and say, hey, we here at IBM were right about that. But there's no doubt they were probably saying that because it fits in nicely with one of their business models. Over the last many years, IBM has sort of been building a kind of a mini Accenture, a mini consulting company, where they are consulting to companies that want to do things like introduce AI to make them more efficient. And obviously, if new AI models are more open and less proprietary, like the DeepSeek model is, it's less costly and easier to help companies develop what he calls like fit for purpose models that are going to be not so expensive, so that they can do so they can use AI to make their companies more efficient, solve problems for their company. So you can see that IBM is just one of those companies that's been is potentially a beneficiary for what Krishna refers to as the lessons that we've learned from DeepSeek. And the market seems to have already kind of recognized that, because although IBM is, we have a lot of KN clients who followed Warren Buffett into IBM many years ago and really didn't have a very good result with the stock. But over a shorter period of time, like over the last 6 months, IBM shares are up 44%. So the company sort of recognizes that IBM seems to be onto a good thing here. And at the beginning, a few minutes ago, I compared IBM to Accenture, and Accenture was a stock that just really went crazy during COVID. It collapsed. And you can see kind of on the same theme, its share just keeps ticking up, and it's now only about 10% or less away from its all-time high. So its share has been doing well as well. So my lesson there for the DeepSeek is the lessons that you get from DeepSeek. Some of it is negative in that there may be fewer data centers built and some companies that will hurt them. But on the other hand, other companies are going to benefit from if there are cheaper and more open AI models out there in the future. Now to go to Trump's tariffs. Well, since one of the articles I read this morning was in the London Times. It was written by their economic editor. And more or less, I'm sort of paraphrasing here. You can read the real article because it's a little more, if you want the details. But basically what the article said, yeah, these tariffs are, kind of can be bad, but they're better than just having all these sanctions that the Biden administration was doing almost on a weekly basis. They were announcing sanctions. So it's better to just sort of have broad tariffs against against countries for imports than it would be to try to be sanctioning Russia and kind of trying to remove them from the global financial system, or trying to restrict China from being able to buy the highest quality Nvidia chips. Trump has threatened Canada and Mexico with tariffs, and he did put an additional tariff on China. But that's still better than the sanction-based policy of the Biden administration. Earlier, I said that I had mentioned that I expected the market to be resilient with all these strong earnings. And I'd just like to bring you back to why I thought the market needed to be resilient. And I said that at a time when Treasury yields were going up and up. And obviously that was creating headwinds for the equity market. And I was more or less saying, I don't think it's going to be that bad. Well, since then, Treasury yields have come down some. The last Fed meeting, they didn't say anything to encourage people that the Fed's got to be cutting interest anytime soon. So that may sound like, oh, that was a hawkish meeting. But Jay Powell, in his press conference afterward, said more than once that he thought that interest rates were already high enough to bring inflation down. So basically, if you were worried about inflation going up because of Trump's tariffs and maybe the Fed actually raising rates, that seems to be totally off the table now. So in response, I think that's why Treasury yields have come down over the last 10 days or so. And if that keeps happening, that's got to mean that the current kind of tailwind behind the U.S. equity market is got to keep going forward. We have a big number that's important to the Treasury market, as it always is, the non-farm payroll number, which is out Friday. Expectations are that that number will be around 170,000 jobs created. As I've said before, with those fires in California, and still you're talking about January, so you have all the layoffs that happen after Christmas ends, and of course the people who put the numbers together try to do some sort of adjustments for those. So anyhow, in reality, whatever the number is, if you think that people were logical, they wouldn't pay too much attention to it because they'd realize it's a number affected by a bunch of factors that really don't tell you how the overall market's doing. But that's not how things work. If that number is very strong, you're going to hear Treasury yields go up. And, you'll see the stock market probably go down a bit on that news. But I think we can be optimistic maybe that this time the non-farm payroll number will be in line with expectations, or maybe even a little bit lower, which should keep the recent trend of Treasury yields declining in place. And like I said, that makes me optimistic about the U.S. equity market.